It's genuinely shocking how much financial success slips through the fingers of even the most driven individuals, entrepreneurs with groundbreaking ideas, professionals hitting every career milestone, and investors meticulously researching their next move, all because of these like deeply ingrained psychological patterns. We're not talking about market downturns, we're talking about the costly impact of our own minds. Okay, let's unpack this. Welcome to the deep dive.
And today, we're diving deep into a topic that's vital for anyone looking to build and protect their wealth. Behavioral Finance 101, mental traps that sabotage your wealth. Whether you, our listener, are, say, gearing up for a crucial business negotiation, trying to make sense of the financial landscape, or just have a curious mind, this is for you. We've looked at a range of sources to put out the core insights, kind of your shortcut to being more informed financially without getting bogged down in like overwhelming detail.
Exactly. Think of it as understanding the hidden code that often dictates our financial choices. Our goal isn't really to teach complex theories, but to, dissect the common mental missteps we all make, show their real-world consequences with compelling examples and data, and, most importantly, empower you to spot and navigate these biases in your own financial journey. So with that in mind, where do we see people most commonly stumble right out of the gate?
Often the biggest wealth erosion starts with something that seems simple. Consistently spending more money than you actually make. This isn't just about the occasional splurge. It's a recurring pattern that inevitably leads to the, quicksand of debt.
Huh.
What's fascinating here is the psychological bit. That pull of instant gratification often just outweighs the long-term pain of overspending.
Right, that constant juggling act, never quite getting ahead. And as we saw in some of the materials, this isn't just about the immediate stress of bills. It fundamentally undermines your ability to build any kind of security for the future. One of the things highlighted was taking a good hard look at where your money is actually going. Huntington Bank, for instance, offers tools like their spend analysis, which visually breaks down your spending. It's about making the invisible visible.
And that visibility, that's the crucial first step towards gaining control. Once you have a clear picture of your spending habits, like Huntington Bank emphasizes, you can start to pinpoint those areas where you can realistically cut back. That freed up cash can then be directed towards not just tackling debt, but also, and maybe more importantly, building your savings. Their savings goal getter and emergency fund calculator are like practical ways they help users structure that whole process.
Which brings us to another critical and, wow, surprisingly common misstep. Not having an emergency fund. It's like walking a tightrope without a safety net, isn't it? Life, as we all know, loves to throw curveballs, a sudden car repair, a plumbing disaster, unexpected travel. Without dedicated savings, you're often forced into making financially tough choices, maybe even taking on more debt.
Precisely. And the peace of mind that comes with knowing you have a financial cushion is just invaluable. U.S. banks suggest aiming for an emergency fund that covers, 3 to 6 months of your essential household expenses?
Yeah.
Now, that might sound like a lot.
Yeah, that can feel like a mountain to climb for some. Is there a more manageable starting point?
Oh, absolutely. Even starting with a smaller, achievable goal and just consistently putting money aside each month builds that vital safety net over time. The key really is the habit of saving. And as U.S. Bank also points out, it's worth looking into different savings account options because some do offer better interest rates, letting your emergency funds grow a little while they're just sitting there.
Okay. Now, it's not always the big dramatic expenses that derail us, is it? Sometimes it's the pileup of those smaller everyday costs that can really eat away at our financial well-being.
Exactly. One of our sources calls this overlooking the little things. That daily latte, grabbing lunch out instead of packing one, those seemingly minor subscription fees individually, they might seem tiny. But when you compound them over weeks, months, years, the total can be pretty staggering. It's like a slow drip that eventually empties the tank.
It's the financial version of death by 1,000 paper cuts. And the solution, while simple in theory, often needs conscious effort tracking your regular spending. Just like Huntington's spend analysis, there are tons of apps, or even, old-fashioned pen and paper to see where the money goes. Seeing those small things add up can be a real wake-up call and shows surprisingly easy places to cut back, freeing up funds for, bigger financial goals.
And those seemingly small cutbacks can definitely pave the way for more significant financial growth, especially when you direct that money towards investing. This is another big area where many ambitious folks unintentionally hold themselves back financially by not investing or by starting way too late.
This feels super relevant for the entrepreneurs and professionals we mentioned earlier. Often their energy is so focused on their careers or businesses that thinking about long-term investing feels like something they can deal with later. But our sources are clear. Investing is a fundamental engine for building wealth over time. That power of compounding is truly remarkable.
It really is. And while the reasons for putting it off, maybe lack of knowledge, fear of the market going down, or just feeling like you don't have enough cash to start, are understandable, the cost of waiting can be huge. The beauty of compounding is that your earnings start generating their own earnings. Delaying that initial investment, even by just a few years, means missing out on those crucial early cycles of growth, making it significantly harder to hit those long-term goals, like buying a house, paying for education, or retiring comfortably. It's like a snowball rolling downhill. The sooner it starts, the bigger it gets.
So the early bird really does get the worm with investing. Okay, let's shift focus a bit to the internal stories we tell ourselves about money, what one source called telling yourself financial lies.
Yes, this is a subtle but incredibly damaging pattern. It's
Yeah.
the tendency to kind of avoid facing uncomfortable financial truths, like ignoring growing debt or clinging to the illusion that a temporary fix, maybe skipping a loan payment, somehow solves a real problem. It's basically a form of financial denial.
It's like burying your head in the sand and hoping the problem just disappears. But as the info from Huntington Bank stressed, debt doesn't just vanish if you ignore it. Usually the opposite happens. It tends to grow and become an even bigger burden over time if you don't proactively deal with it through responsible repayment plans.
So those are some of the more, let's say, fundamental behavioral pitfalls. But the field of behavioral finance really puts a spotlight on the specific cognitive biases that systematically mess with our financial decision-making.
Ah.
Let's start by unpacking confirmation bias. What exactly is that?
Okay, confirmation bias is basically our built-in tendency to actively look for information that fits with what we already believe, while kind of ignoring or downplaying anything that contradicts those beliefs. It's like having a mental filter that says yes to agreeable data and nope to everything else. And what's really interesting, as our sources point out, is that this isn't usually like a conscious thing. It's an unintentional, often unconscious way our brains handle information.
What's particularly interesting is that the more expertise we gain in a certain area, the more likely we might be to fall into confirmation bias. Our confidence in what we already know can inadvertently make us even pickier about the information we let in, leading us to just look for validation. It's kind of counterintuitive. You'd think more knowledge would mean more open-mindedness, right?
That's a fascinating paradox. How does this actually play out in the investment world?
Well, imagine someone's convinced a particular tech stock is going to boom. Because of confirmation bias, they might only read news articles and analyst reports that predict a rosy future for that stock, while totally disregarding any reports raising red flags about the company's finances or potential risks. This selective info gathering can lead to investment portfolios that are way too concentrated, maybe too risky, or just not diversified enough because the investor isn't seeing the full picture. And as one source highlights, when you do show someone info that challenges their deep-seated investment beliefs, it can trigger cognitive dissonance, that uncomfortable mental clash. To ease that discomfort, they might just dig their heels in even more, reinforcing the bias.
Wow. So it's not just about making potentially bad decisions initially, it's also about being resistant to learning from new info that might point to a better path. Okay, next up, availability bias. This sounds like it relates to how easily stuff comes to mind.
Exactly. Availability bias is our tendency to overestimate how likely or common events are if they're easy to recall or really vivid in our memories. Think about heavily publicized but statistically rare stuff like winning the lottery or a huge economic crisis that's all over the news. Because these events are so memorable and get so much attention, we might overestimate how likely they actually are and the risk they pose in our own lives compared to more common but less flashy events.
That makes total sense. The more something's in the headlines, the more we tend to think it's a bigger deal than it might be statistically. How does this show up in our financial choices?
One source gives a pretty good example. Imagine an entrepreneur who's read several stories about startups hitting massive valuations and having quick, successful exits. Because of availability bias, they might overestimate the potential upside of taking significant equity in their own startup versus getting a more stable, higher salary. Even though statistically most startups don't hit those unicorn levels, those super visible success stories are more readily available in their mind, skewing how they see the risk and reward.
So the exception kind of becomes the rule in our mental math.
Precisely. And this bias can also mess up how we evaluate progress in, say, business strategies. When looking at how well a new initiative is doing, there might be a temptation to focus only on the most dramatic success stories or glowing reviews. While those can be encouraging, relying only on the most easily available but maybe unrepresentative, data can lead decision makers to a wrong understanding of the overall impact and actual progress.
It's a good reminder to look beyond the loudest stories and check out the whole data set. Let's move on to anchoring. What kind of mental shortcut is that one?
Anchoring is our tendency to really latch on to the very first piece of information we get, even if it's totally irrelevant or random, and use it as a benchmark or anchor for making later judgments and decisions.
Can you give us a practical example of how this might sway our financial decisions?
A classic example is in negotiations, whether it's for a salary or buying a car. The first number thrown out there often sets an anchor, even if that initial number isn't based on any real value. For instance, if a used car is initially listed at a super high price, even if you negotiate it down a lot, you might still feel like you got a good deal just because you're anchored to that inflated starting price.
So that first piece of info acts like a magnet, pulling our later judgments towards it.
Exactly. And this definitely plays out in investing too. Think about a stock that was trading at $100 and then drops to $80. Even if $80 is still way overvalued based on the company's actual financial health, many investors will see it as a bargain simply because they're anchored to that initial $100 price. They fixated on that first number, regardless of its current relevance. This can lead to overvaluing things and making choices based on false assumptions tied to that first anchor.
Now, loss aversion is a concept we hear about a lot in behavioral finance chats. What's the main idea behind it?
At its core, loss aversion refers to that well-known psychological thing, where the pain we feel from a loss is significantly stronger than the pleasure we get from an equivalent gain. It's not symmetrical. Losing $100 often feels much worse than the good feeling of gaining $100. Some studies suggest the negative feeling can be like twice as powerful.
How does this natural aversion to loss affect our investment decisions? It sounds like it could make people too cautious.
It definitely can lead to being overly risk-averse sometimes. But a more common way it shows up in investing is the difficulty many people have selling a losing investment. Even when all the rational analysis says it's the best move to cut their losses and put that money somewhere better, the emotional pain of actually realizing that loss can be so strong that they just hold on, hoping it'll bounce back. As one of our sources mentioned, analysts might even find ways to keep recommending a declining stock, partly driven by this aversion to admitting they were wrong initially.
It's like clinging to a bad hand in poker because you've already put so much money in the pot.
Exactly. And loss aversion can also stop us from taking a truly long-term view on investments. Some types of investments might take years, even decades, to really grow significantly. Seeing your investment temporarily dip can be hard to stomach because of this built-in loss aversion, potentially causing investors to ditch a solid long-term strategy too early.
That makes a lot of sense. Explains why some folks might shy away from investments that could have huge long-term potential, but might also bounce around a bit in the short term. Okay, let's move on to the sunk cost fallacy. The name itself kind of suggests it's about past investments influencing current decisions.
You're absolutely right. The sunk cost fallacy is our tendency to keep pouring time, money, or effort into something just because of what we've already put in. Even when it's clear it's not the most rational or beneficial path anymore, we feel like we have to keep going because of those unrecoverable sunk costs.
How might this show up in finance and investment analysis?
Well, one source gives a relevant example with equity research analysts. When an analyst starts covering a whole industry sector, they might feel pressured to recommend a bunch of stocks within that sector, even if their later research shows only a few really look promising. This could be partly because of the huge amount of time and effort already spent researching all those companies, the sunk cost. They feel they need to justify that initial time investment by issuing more recommendations. Similarly, an analyst might resist downgrading a buy recommendation even when the company's doing poorly and their original investment idea has failed, just because they've already put so much time and effort into researching and promoting that specific stock.
So, past effort clouds future judgment. The source mentioned a couple of best practices for analysts to help fight this. What were those again?
Yeah, one key piece of advice was for analysts to periodically ask themselves a crucial question. If I were starting fresh today with no prior involvement, would I still make this same recommendation? That helps detach the current decision from the weight of past efforts. They should also try to cultivate a willingness to reverse their recommendations when the original thesis just isn't working out anymore, acknowledging that past effort doesn't justify sticking with a losing idea. Another suggestion was to regularly ask, if I switched firms tomorrow, would my stock picks at the new place match my current ones? This can help reveal if current recommendations are truly objective or may be influenced by past time invested at their current firm.
Those are great strategies for encouraging more objective decisions. Now let's tackle overconfidence bias. This one sounds pretty straightforward.
It is, in concept. Overconfidence bias is basically having an inflated belief in your own abilities, judgment, or knowledge, especially when it comes to predicting investment outcomes or spotting patterns where none actually exist. It's that feeling of, I'm better at this than the average person, or I just have a knack for picking winners.
It's like thinking you consistently have an edge over the market, kind of like a gambler who thinks they're on an unstoppable hot streak.
Exactly. And the danger with overconfidence is that it can lead to taking way too much risk, underestimating potential downsides, and failing to diversify properly because you genuinely believe you can pick the winners yourself. One of our sources suggests several ways people can try to dial back overconfidence in their financial decisions.
Like what?
Encouraging regular self-reflection on past investment choices and their actual outcomes, comparing those outcomes against objective benchmarks, not just gut feeling. Also, having open and honest talks with financial advisors or trusted friends about the potential risks in different strategies, setting realistic and clear financial goals, and consistently tracking progress against those goals using objective data. It's about grounding your investment decisions in a realistic view of your skills and the market's inherent uncertainties, rather than just an overblown sense of self-belief.
Then there's hindsight bias, which I think most of us can probably recognize in ourselves sometimes.
Hindsight bias is that classic I knew it all along feeling. It's when we look back at past market movements or big financial events and falsely believe they were predictable even though they really weren't at the time.
So after a major market drop, we might look back and say, oh yeah, it was obvious that was going to happen.
Precisely. And the sneaky thing about hindsight bias is it can create a false sense of security and lead us to think we're better at predicting future market moves than we actually are. As one source clearly states, consistently and accurately predicting future market behavior is pretty much impossible. This illusion of predictability can then lead to making future investment decisions based on flawed ideas about our own forecasting abilities.
It's a dangerous illusion of control that can lead to being overconfident about future predictions. Okay, next is mental accounting. This sounds like it's about how we mentally bucket our money.
That's a very accurate way to put it. Mental accounting refers to how we tend to mentally categorize and treat different piles of money differently, often based on where it came from or what we plan to use it for. For example, we might handle a tax refund or a birthday gift very differently from how we manage our regular paycheck.
I can definitely relate to that. I know I'm personally more likely to splurge on something fun with unexpected money than I would be with my regular income, even if the dollar amounts are the same.
That's a super common example of mental accounting. And as one source highlighted, this can extend to windfalls like winnings from a bet, often called the house money effect. If you're playing with money you've won, you might be willing to take much bigger risks than you would with your original stake, even though logically every dollar should have the same value and a potential. Right.
So we're basically creating these artificial walls around different parts of our money.
Exactly. And our sources also touched on how our reference points for gains and losses can shift over time, significantly changing how we see financial outcomes. They give a strong example of investors who were unhappy with their portfolio's recent performance, even though they'd seen huge long-term growth. Their mental reference point had shifted to a recent peak, making them focus on the drop since then rather than the overall long-term gain.
Wow, that really highlights how our mental framing can completely change how we feel about the same underlying financial reality. Moving on, we have recency bias. This sounds like it might be related to availability bias, but more focused on the timing of events.
You got it. Recency bias is the tendency to put more weight on recent events compared to things that happened further in the past. In the investment world, this can lead to statements like, "It's different this time." When people make investment decisions heavily influenced by recent market trends, often ignoring longer-term historical data that might suggest a different outcome is likely.
So if the market's been going up strongly lately, people might just assume that trend will continue forever, even if history shows those kinds of runs rarely last long term.
Precisely. And this can lead to the risky habit of chasing recent winners, maybe buying assets when they're already expensive, just as a recent market dip might cause some investors to sell everything out of fear, even if the long-term reasons for holding their investments haven't actually changed. One source suggests financial pros can help clients fight recency bias by actively making them aware of this natural tendency. By consistently sharing relevant historical data for a more balanced long-term view, and by continually teaching them the importance of sticking to a well-planned, long-term asset allocation strategy.
It's about reminding ourselves that markets don't just go up in a straight line, and that a longer-term view is usually the smarter approach. Now let's talk about herd mentality. This one seems to describe our urge to just follow what everyone else is doing.
That's exactly it. Herd mentality in finance is the tendency to make financial decisions based on what a large group of other people are doing, often with the hidden assumption that the majority must be right or that there's safety in numbers.
We see this happen over and over, whether it was in bubbles like the dot-com era or more recently with things like meme stocks.
Indeed. And while following the crowd might feel less risky, it can often pull you away from your own clear long-term financial goals and potentially cause you to take on risks that aren't right for you or get lower returns than a more personalized, thought-out strategy. One source suggests that if you find yourself really susceptible to that emotional pull of FOMO, fear of missing out on a popular trend, it can actually help to intentionally limit how much news and social media you consume about that specific topic. This can help you avoid getting swept up in the collective hype or panic and stay focused on your own individual financial plan.
It's about tuning out the noise and sticking to your own well-reasoned strategy. Finally, let's touch on the fear of failure, which is undoubtedly a huge emotional force in all parts of our lives and definitely in our financial decisions.
Absolutely. The fear of losing money and the anxiety that comes with it can often lead to poor investment choices that aren't based on solid analysis. For instance, someone gripped by fear might feel a constant need to mess with their investments, making frequent changes even when the underlying reasons for holding them haven't changed, just as a way to feel like they have some control over an uncertain situation. One source recommends that doing deep research and thorough scenario analysis can be really powerful tools to help lessen this anxiety and lead to more rational, informed financial choices. By understanding the possible range of outcomes and having a plan for different scenarios, you can feel more in control and less driven by pure fear.
And what about the snakebite effect that one of the sources mentioned? That's a vivid name.
Yeah, the snakebite effect describes the tendency to completely dismiss a particular stock or even a whole asset class as a bad investment just because of one past negative experience with it. It's like saying, I'll never invest in tech again, after one tech stock did poorly. The advice here is to resist making such sweeping statements based on past losses. Instead, it's crucial to do a more objective analysis of why that past investment didn't work out. Were the problems specific to that company's management, or were they broader industry-wide issues? Sometimes a company's past weaknesses, especially if there have been big changes like new leadership or a shift in strategy, can actually present opportunities for future growth and potentially significant upside.
So it's about learning from the past without letting it create rigid rules that might limit you in the future. Wow. This has been a really insightful look into the many subtle ways our own psychology can accidentally sabotage our efforts to build and keep wealth.
It has. And just to quickly recap some key takeaways for you, our listener. We've looked at how easily we can fall into basic traps, like consistently spending more than we earn, skipping the crucial safety net of an emergency fund, and underestimating how much those small, everyday expenses add up. We've also dug into a whole range of cognitive biases that can systematically warp our financial judgment, from how we seek out confirming info and rely on easily remembered events, to the powerful pull of anchoring, our stronger dislike of losses compared to gains, and our tendency to cling to past investments even when better options exist.
And we've seen how overconfidence can lead to taking too much risk, how hindsight bias creates a false sense of predictability, how mental accounting makes us treat money kind of irrationally, how recency bias can make us overreact to short-term market swings, how herd mentality can lead us away from our own goals, and how the fear of failure can either paralyze us or lead to rash decisions. The critical first step in overcoming these wealth-draining tendencies, as we've stressed throughout this, is simply recognizing that these biases are a natural part of being human and understanding how they might be affecting your own financial behaviors.
So, as you go about your financial decisions this week, maybe you're thinking about new investments, looking over your budget, or just reading the financial news, make a conscious effort to watch for these mental traps in action within your own thinking. Ask yourself, am I only paying attention to stuff that supports what I already think? Am I giving too much importance to recent events? Am I anchored to some initial piece of info that might not even be relevant now? Developing this heightened self-awareness is the very first and maybe the most powerful step towards making more informed and rational financial choices that actually line up with your long-term goals.
Absolutely. Remember, proactively gaining knowledge about these built-in psychological factors is a huge step towards reaching your financial ambitions. It's about understanding the hidden influences that can so often shape our decisions, sometimes without us even realizing it.
And on that note, here's a final thought for you to chew on. Now that you have a deeper grasp of these often unconscious influences on your financial life, maybe take some dedicated time this week to really reflect on which of these biases might be most relevant to your own past financial decisions and your future plans. Consider how consistently applying this knowledge, not just knowing it intellectually, but actively using it to challenge your own assumptions and decision-making, could fundamentally reshape not just your investment portfolio, but your entire relationship with wealth and your ability to achieve your most important financial goals.